Hi, Terry Reddock from the Property Investment Channel. When appraisers and real estate brokers are asked to value a property, there are three ways or approaches, as we say, that we use. The first is a cost approach, the second is a comparative approach, and the final one is the income approach. Depending on the purpose of the valuation, is this for finance, insurance, or resale, or the type of building, some will be appropriate and some won't. Let's go through each one in order, see how they work, and when they're appropriate. The cost approach. What is it and when do we want to use it? The cost approach seeks to assign a value to a building based on the replacement cost, hence the cost approach. We think labor, we think materials, land. If we've got a relatively new building, it's an appropriate approach. I know what a 2x4 costs. I know what a cubic yard of cement costs. I know what carpenters are charging per hour, plumbers, electricians. I'm going to be able to put together a fairly accurate picture of the replacement cost of this building. Now, let's look at this example. Let's pretend you're asked to assign a value to a building in downtown Montreal or downtown Kingston. It's 200 years old. How much does a cubic yard of limestone cost? What is the going rate for a stonemason? Can you find a stonemason? As you can see, putting together a valuation on this building using the cost approach is going to be a little bit tricky. So, newer building where you know the price of labor and materials, it's fine. The further back in time you go, the more problematic it becomes. The comparative approach. When do we want to use it? How does it work? The comparative approach is the one that you're most familiar with at home. And it's the approach that residential agents use almost exclusively. In essence, it follows the following logic. That house across the street, which is identical to mine, sold for $100. So my house is worth $100. Well, the problem is no two houses are ever identical, even in new subdivisions. You're next to a school, I'm not. You've got a corner lot, I don't. I get a lovely sunset, you don't. So adjustments need to be made. And that's the trick in the comparative approach. Let's see how it works. Okay, so we need to find the value or the list price for the subject house. Let's take a look at the screen here. We've identified three comparable properties. So comparable, they're close in the neighborhood, same age, same state of repair. We notice that the only differences between the comparable properties and the subject house are bathrooms and whether or not the basement is finished or unfinished. So what we need to do is see, what does a bathroom cost? What does a finished basement cost? To do that, we're going to look at the comparable properties that have sold. And the reason why we're using the ones that have sold is they are market proven prices. Take a look. House A, House B. The only difference there is one has a finished basement and one has an unfinished basement. So we take a look at the difference in the price. $100 with a finished, unfinished, you get it discounted $90. So we know that the market will pay $10 for a finished basement. Take a look at House A and C. The only difference there is one, House C, has got an extra bathroom. What's the difference in the price? $100 versus $105. So we know that the market will pay $5 for a bathroom. Finished basement, you get an extra $10. Extra bathroom, you get another $5. So, step three, what we do now is we compare each of those comparable properties to the subject property. So now what we need to do is compare each of the comps to the subject house. House A, what's the difference? Well, it's got one extra bathroom, that's $5, and it's got a finished basement, that's $10. So it is $15 better than the subject house. 100 minus 15, $85. What about house B? Well, what's the difference there? Well, it's one bathroom better. It is $5 better than the subject house. What did it sell for? 90 minus 5, $85. House C, well, this one's a little bit trickier. It is two bathrooms better, 5 plus 5 is 10, and it is one basement better, 10, for a total of 20. What did it sell for? Well, it sold for $105 minus 20. Wow, lo and behold, again, $85. So we know that the subject house is worth $85. Of course, adjustments are never that cut and dry. Regardless, that should give you a pretty good handle on how the comparative approach works. What is the income approach and when do we use it? Well, the income approach seeks to assign a value to a building based on the income it either could or is producing, hence income approach. It's best used for things like apartment buildings, for example. Before we get into how the income approach works, we do need to understand one key concept called a capitalization rate. A cap rate is the way the market decides whether or not a building is worth pursuing by looking at the ratio between the rent that you're collecting and the proposed purchase price. So it's that ratio between rent and what you're going to pay for the building. Think of it this way: for every dollar you spend in real estate, how many pennies are you going to get in rent? If you've got a building, for every dollar that you spend on the purchase price, you're getting 8 or 9 cents. That's good. If, on the other hand, you're looking at a building, for every dollar you spend in purchase, you're only getting 3 or 4 cents, that's not as good. And that is captured in something called the capitalization rate. We specifically define the cap rate as the net operating income, NOI, divided by the purchase price. So net operating income divided by purchase price. The easiest way to explain what net operating income is and cap is, let's take a look at an example. Okay, so net operating income, that's the first thing we've got to figure out. Net operating income, I want you to think of it this way: it's all the money going into your bank account minus all the money going out of your bank account before your mortgage. So all the money in minus all the money out before your mortgage. Okay, in this example that we've got up here, we're going to look at a simple duplex. First thing that we're going to figure out is all the money going in. That is captured in something called the gross annual income. So gross, everything, annual, and income is the money that's coming in. It's in two parts, as you can see. In this duplex, we've got rental income. So unit 1 and unit 2, they're paying $500 and $800. And we also have other income. So are you charging for parking? Are you charging for internet? Are you charging for laundry? Well, in this instance, we're getting $50 a month for parking and $25 for laundry. Remember, it's gross annual. So we're shoving everything to annual. So the gross annual income, all the money going into this landlord's bank account, is $16,500. What about the money going out of the bank account? Okay, well, let's take a look. So all the money out is captured in something called the total annual expenses. Total, everything, annual, and expenses are expenses. We have property tax, utilities, insurance, maintenance. All right, so that comes to a total of $3,600. Remember, there is no finance and no mortgage in this. So our net operating income, all the money in minus all the money out. Let's see what our net is. Gross annual income, $16,500 minus total annual expenses of $3,600 gives us a net operating income of $12,900. So that's the net operating income. Capitalization rate equals net operating income divided by purchase price. Okay, so let's put all of this together now. We've got the net operating income, and we are going to pretend that this building is worth $300,000. How do we figure out the cap rate? Well, net operating income, what was that? 12,900 divided by the purchase price, 300,000, gives us a cap rate of 0.043 or 4.3%. So for every dollar that we spent on this duplex, we are getting 4.3 cents in rent. Now that we know how to figure out a cap rate, we need to see how it fits in and is used in the income approach. We remember net operating income divided by the purchase price gives us the cap rate. Well, we're looking for the purchase price, so we can't have it in the bottom of that equation. We need to solve for it. Through the mystery and magic of grade 9 math, if that's true, it is also true that the purchase price equals the net operating income divided by the cap rate. We know how to figure out the net operating income. You call the landlord, property manager, listing agent, you can figure out the net operating income, all the money in, gross annual, minus all the money out, total annual expenses, we get our net operating income. But what about the cap rate? How do we figure that out? Well, it is in a sense very close to the comparative approach in the residential market. What everybody does is we look at past sales of similar assets, in this case apartment buildings, and we see what the market was paying in terms of a cap rate. Let's look at an example of how that works. Up on the screen, we've got 6 buildings that are similar to the one that we're trying to price that have sold recently. The cap rates were between 1% and 5.5%. They gave an average, a true average of 3.4%. But let's take a better look. Let's take a closer look. I'm seeing building A and I'm seeing building F that appear to be outliers. So I'm going to remove those for the average, and I'm going to come up with an adjusted average cap rate of 4.5%. We figure out the NOI, we figure out what the cap rate is, and then we solve for the purchase price. Let's see how this works using the duplex from a few moments ago. That duplex we know had an NOI of $12,900. We have just figured out that the market cap rate is 0.045. So simple math is $12,900 divided by 0.045 gives us a purchase price of $286,666.67. That's how the income approach works. We look at the market capitalization rate, we look at the income, and we figure out what the purchase price is. Okay, so we have gone over the cost approach, we've gone over the comparative approach, and we've gone over the income approach. The 3 ways that appraisers and real estate brokers value properties. If you have any questions, I'd love to hear from you. And if you have a building that you're thinking about selling, love to talk to you about that as well. Thank you very much for watching. See you next time.